Hi everyone, good morning.
Good morning, sir.
Good morning.
We'll just wait a couple of minutes. Good morning, everyone. Okay, we can start. I'm going to share my screen. As I said yesterday, from today, actually, we are going to begin all the learning all the concepts of technical analysis, starting with Dow theory. This particular chapter has been written by the founder of CMT, Ralph Acampora, and usually in most of the literature on technical analysis, usually the first of the chapters is always Dow theory. It is considered the classical or the very first theory that was ever written about charting or technical analysis, formulated by Charles Dow, finished by Hamilton and Robert Rhea. And usually people don't tend to pay a lot of attention to this because in modern technical analysis, you have so many tools and, such great names and thousands of different indicators and everything, because of which Dow theory may have lost its relevance, at least among the new modern crowd of investments. But as I've told you, the Dow theory is the base of all technical analysis theories today. Whatever Charles Dow found about more than 100 years back continues till today. Maybe not exactly the way he envisioned, because remember that when Charles Dow created his Dow theory, there was not enough data there was no Dow Jones index, for an example. He had to create his own index, two indices that he created, and then he started studying the market. So there was a little less amount of data. So over a period of time, Dow theory has evolved. There are some people who are Dow theorists who have modernized the Dow theory, but I still feel that the basic version still stands very well as a generic, simplistic theory, and that is what we are going to learn today. These learning objectives are very important. Usually my experience and experience of other students who have attempted the CMT exams, they tell me that most of the questions are linked in a way to these objective statements. Okay, so what are the objective statements for this particular chapter? So we are going to talk about two indices that Dow employed in his analysis. We know that the Dow Jones Industrial Index was created by Charles Dow, and the Dow Jones Railroad Index was also created by Dow. The railroad is now renamed as the Transportation Index because there are no more. The transportation used to happen through the railroads 100 years back, but now it happens through air, by train, by sea, and things like that. So transportation is the right word for that. Also, we need to figure out why Charles Dow found these two averages to be important. Of course, this knowledge is a little ancient, or maybe, for an example, for India, you might have to modify the nature of these two averages. We'll come to that in a little while. Most importantly, the basic tenets and the guidelines of the Dow theory, what Dow believed or what Dow figured out. Number 4, the most important price of the day according to the Dow theory. Remember, there were no bar charts, there were no candlestick charts. The only kind of charts that were available at that point of time were line charts. And line charts basically connect closing price of one day to the next. Okay, so naturally speaking, the most important price of the day is the closing price according to Charles Dow, and it still stands today. It has never changed. Define what is meant by confirmation. Again, confirmation is with respect to the point number 1 and 2 of these objective statements. And most importantly, identify the three primary price movements. Okay. Now, when you look at this particular chapter, it may not really be too much. This chapter is so small, it is over in about 3 pages. But trust me, it cannot be, because Dow theory needs a little bit of explanation. They have given a concise view of this particular chapter. I might want to expand a little, okay, show you many charts and try to get you the idea of the usability or applicability of the Dow theory. Excellent idea. Thank you. In the late 19th century, around 1895 or something, there were not many economists or analysts as such to help identify the health and well-being of the US economy. Remember what they want to do. They want to figure out what the economy is doing, right? So for that, Charles Dow needed to come up with some way to measure the US economy. Okay, he initially started with the railroad average. The dates are not really that important. Okay, he felt that he must follow the stock prices of the company within the nation's largest industry. Okay, and at that point of time, the largest industry was railroads. But as time passed, he sensed that something was missing. The railroad companies made their profits by hauling other companies' products. Hence, the producers of the products are also as important as the companies which are transporting these products. And that is how the Dow Jones Industrial came into existence. We already had the railroad average. These two averages, the railroads and the industrials, must confirm each other's price trends. And by doing so, the moves had meanings. What do you mean by confirmation in a way? So these two indices tend usually ideally should be moving in together. For an example, if Dow okay, let me call it railroad, and industrials, these two should move in the same direction. For an example, let's say the railroads is sideways, but the industrials are moving forward. In this case, the industrials are showing strength, but the railroads are not showing strength. So this is called non-confirmation. Okay, and vice versa. Both of them should ideally also move together on the downside or on the upside, either ways. Okay, this sets the stage for confirmation, because remember, at about 100 or so years back, things were much more simplistic, and those simplistic things said that, okay, you know what, companies are producing goods, but if there is nobody to transport, why there is nobody to transport, our transportation is not happening, maybe people are not buying those kind of products, so there is no need to transport those products. So according to him, both the industrials and the transportation held some value, and they mimicked each other, or they were coincident with each other, for an example. Okay, so when we look at all the Dow theory buy signals, we are basically looking at the confirmation between these two signals. Now, it is possible that when you go to other countries, you may not have the railroads, and maybe you don't have the industrials. So for an example, for India, the primary index is Nifty or the Sensex, as the case may be. Now, we don't know exactly what we can use for confirmation. Okay, but then there are many uh, options available. For an example, Bank Nifty. There has been never a bull market without banking stocks being a part of it. There is IT or tech, as we call. These are the two major indices or major components of the Indian economy, right? Banking and IT tech. They have massive capitalizations as such. You can also say that, okay, why don't we go to the broader market and why don't we track mid cap and maybe to a certain extent small cap, if at all. Generally, mid cap and small cap need strength coming from the primary indices. Even if mid cap and small cap tend to run very fast, uh, they need support. They need the directional bias of Nifty and Sensex. So usually you will never see that mid cap and small cap indices are rallying without any rally in the in the Nifty or the Sensex. Okay, so for India, the jury is out. We don't really know what we can use as a confirmation average, but these are all the options that are available to us. You can also go a step further and you can say that, okay, you know what? Let's say there are about 15 sectors. I don't know exactly how many. I'm just saying, let's say if there are 15 sectors, then you can compare these charts of 15 different sectors, like say FMCG or oil and gas and things like that, with Nifty and Sensex. Now, all of the 15 sectors are not going to always conform to Nifty and Sensex. Only a few of them are. But if majority of sectors are making new highs and Nifty and Sensex are also making new highs, then naturally speaking, we are looking at confirmation. These are just simple ideas that you can use. Confirmation is important, if you ask me, because in the world of technical analysis, we do not know anything for certain. Okay, the charts are telling us everything, but the charts sometimes are also trapping mechanisms. They may show you something and they may do completely opposite. Okay, so that is the reason at every stage you want various confirmations. Okay, after Charles Dow passed away, Hamilton worked on the Dow theory, and he is the one who coined the term Dow theory. Okay, and after Hamilton, it was Robert Rhea. This book is also good. You may actually find it somewhere on Google, the Dow theory. You may want to have a look at it. Now, most important thing, the basic tenets of the Dow theory. Now, remember, this is the simplistic version of a man who was born about 100 years back. The ideas are very simple, but the ideas are very solid also, because these things have never changed, and I don't think they will ever change as long as stock markets survive. The first one is that stock market is a discounting mechanism. The market looks out at least 3 months into the future, and this cannot be overemphasized. Whatever the market is doing today, it is not reacting to today. It is reacting a few months down the line. Usually it is 1 quarter or 2 quarters. It can also go as much as 1 year. So that is the reason usually uh, you will realize that Dow created the industrials and the railroads to analyze the business cycles of the market. So usually what will happen is, because the market is always ahead of business cycles, the market will peak out and will stop falling, whereas the real economy will continue to rise and fall much later. Okay, maybe 3 months or 6 months later. The market will give a time discount, or let's say the market is a leading indicator of the economy. That is the reason. For an example, if you look at the COVID era, right? When the COVID situation began in the world, the markets crashed massively. That was the first wave. But nothing really happened in the second wave or whatever happened. Why? Because everything that could have gone wrong during COVID, the market quickly discounted it. Okay, everything that can go wrong has been built into this particular correction that we saw during the COVID era. And then after that, in spite of the second wave, you can see that normal corrections do happen in the market from time to time. You cannot really stop them. They are going to happen. So there are multiple corrections the market goes through in a particular bull market. But in the second wave, nothing really happened. Why? Because the market actually discounted it. Now, look at this particular correction here. This correction. This was the Ukraine war correction. I will go to a Heiken-Ashi chart, or maybe a line chart is much easier right now. Okay. This is the Ukraine war, Russia-Ukraine war correction. And while the Russia-Ukraine war continues still today, the market has not really reacted to it. Why? Because all the reaction, everything that could go wrong, they knew that Ukraine was one of the biggest wheat producers. So wheat is not going to come. So there is going to be a food shortage. Food shortage is going to create inflation, and so on and so forth. Everything was built into this particular correction. So the market is always generally looking ahead. And then as new data comes in, new quarterly results come in, any management changes that happen, or any new products that happen, if suddenly some news comes in, the market will adjust to it. Now, if you look at the current correction in the market, okay, so the current correction is looking at, let's say, poor results. They are looking at tariff wars. They are looking at some kind of, for the rest of the world, apart from US, it is looking for some kind of turbulence because there is a new leadership in United States. All of this will be built in or discounted in this particular correction. So that is the reason. And it is not only for indices, okay? Usually, if you see a long-term bear market that is going on and on and on, let's say for 2 years or 3 years, and then here suddenly the stock comes out with very, very bad results, you might realize that the results are way too bad, and then the market bottoms out and it starts rallying. The results were extremely bad, but the market started rallying. Why? Because the market believes that this was the worst result that the stock could give. Now, in the future, now this is today. Today, the stock has produced a weak result, a weak earnings. Now, it cannot really go worse than that. So for the future, there is nothing worse. Yes, there is worse today, and the market has reacted to it. But there is nothing worse than this that is going to come in the future, because of which the market will rally. And this is what dumbfounds most of the beginners that come to the market, that how can a stock rally on a bad news? Or how can a stock fall? I was looking at a period in 2016 or so. The market was 2015, if I'm not wrong, the market was rallying. And here, RBI suddenly comes up with a 50 bips rate cut, suddenly out of nowhere. Okay. Now, 50 bips rate cut is an excellent news for the market, right? Because it reduces the cost of your borrowing. But the market peaked out on this particular day and started going down. Why? Because the market always looks ahead. The market felt that after giving this 50 bips cut, there was no room for RBI to have any rate cut in the near future, and because of which the market is going to decline. It is not the news per se. It is the expectation of the news, or it is the effect of the news, that is more important. Okay. Generally speaking, rising prices, rising commodity prices, rising commodity prices, rising tariff wars, rising tariff wars, anticipate positive news. The stock is going to come out with stellar quarterly results, quarterly earnings. The stock is not going to rally on the day of the quarterly earnings. Yes, it will rally on that day, but the rally has already begun many days back. So by the time you come on the day of the quarterly results, it is already too late. Everything, all expectations of that rally have been built into the price. So you will never see that stocks will actually start rallying on a good result. They have usually they will already be rallying. Like you might suddenly open the newspaper and find some great news about a stock, only to go and see the chart and you realize that, oh, the stock has been rising for a little while. So rising prices anticipate positive news, falling prices anticipate negative news. Dow created two averages, the railroad average and the industrial average. The first one to be created was the railroads, which is now called the Dow Jones Transportation Index. Remember, this kind of questions can come from the section of theory and history. What kind of stocks does transportation include? Transportation index include? So basically airlines and truckers, anything that can transport. The second one is the Dow Jones Industrial Average. Yeah, now you need to remember that for all analysis of Dow theory, only closing prices of these averages are used because they represent the most important prices of the day. They may ask you, why do you think the closing price is the most important price of the day? And the reason is that morning the market opens. Remember, CMT comes from US, so there can be a lot of questions with respect to US. So 9:30 the market opens in US, 4 p.m. it closes. From 9:30 a.m. for every particular stock, for every particular index, there is a struggle between buyers and sellers. Both of them want dominance, if at all. Uh, so dominance to go up, dominance to go down. They will fight throughout the day, the buyers and sellers. And the closing price is considered as the result of the entire fight of the day. So it is one price which sums up all the data, all the fighting, all the struggle, all the battle that occurred during the intraday. So at that point of time, Dow only used the closing prices. Yes, closing prices are important according to me, but I do not, in spite of being a Dow theorist, I do not use line charts because line charts are very, very boring. Line charts may not show some of the patterns that you can see on the high-low charts. Okay, they will be very, very different on. So, for an example, if I give you two charts of the same stock, one stock is in the long term, they will all look similar. Like for an example, Nifty, there is not going to be much difference between a line chart and a candlestick chart. Okay, but when it comes to patterns and all, it might be a little difficult to use the line chart, and you may actually want to go to the bar chart because though highs and lows are not, I mean, they are important, no doubts about it. But many people do believe that the closing prices is all they need. Okay, so uh, and also one more point is that yes, line charts are boring. Line charts are close only charts, but in close only charts, line charts are not the only charts. If you want close only charts, you can also go to something like Renko, and Renko is a beautiful looking chart. Okay, Renko is based on closing prices only, but the plotting method is a little different. Then you have point and figure that is also using the closing prices, as you can see, and gives some definition to the chart so that you can do more analysis as the case may be. You can do tell me why you have shared this chart. I'll come back to it. Okay. The critical word in Dow theory is confirmation. The averages, which averages? Transportation average or slash railroad average plus the industrials must confirm each other's directions. Okay. So these are the rules. You will want to study these rules. The first point is that a confirmed uptrend is when both averages close above their previous important secondary highs. It doesn't need to be very complicated, very simple. Let's say this is the industrials and these are the railroads. I'm still going to call them railroads. Let's say they make a peak and they fall, they make a peak and they fall. Now, the industrial starts rising and goes above this particular peak, and the railroads also start rising, but they have not gone above this particular peak. Now, remember the rule that Dow is talking about, that both the industrials and railroads have to confirm each other by making a new high. Okay, now industrials has made a new high, but railroads has not. So as a Dow theorist, you will not act on it and wait for the railroads to make a high. By that time, industrials may have gone up higher. But now, as you can see, the railroads have gone above the previous high and the industrials are already above the previous highs. So you will get a confirmatory buy signal. Okay, now if there is any confusion, let me simplify it. Let me step away from the market, from the Dow theory, and give you a sense of what highs and lows actually mean. This is the journey of a stock from A to B. Okay, in a linear world, this is how the stock will actually rise from A to B. But when you actually see the real movement of the stock, the real movement is not as linear as this. What will happen is the market will go up, then give a correction, go up, correction, go up, correction. It doesn't have to be exactly linear like what I've done, but this is how the market will move. So through a line drawn in the middle, the market is oscillating around the line in order to make its journey. Okay, let's have a look at one chart. This is a bull market. And I can simply draw a line through it from the low to the high, something like this. And you can see that the market is oscillating around this line. It doesn't have to be a perfect oscillation, but this is how any market is going to rise or fall. It wants to go in a straight line, but because of the noise of the market, it is not allowing to. So what do you glean out of this? What I glean out of this is when the market wants to go up, it is going to make a high, it is going to make a trough, then it is going to cross the previous high and make a new high, and then again fall. This low does not go below the previous low. So new highs are being made, higher lows are being made, and then the market will make a new high. Then the market will come back and make a trough again, which is higher than the previous trough. That is the reason in bull market stocks don't come back to the previous lows. I mean, they come back sometimes, but they do not really come back all the way. This fall can fall all the way here. As long as it is above the previous low, there is no problem. And then the market will go and make a new high. Okay. Now, steep uptrends. This is a steep uptrend. Okay. This is where the market is moving very, very steeply. The form remains the same. The form is always of new highs and higher lows, higher high, higher low, as it is called, right? Sometimes the markets are sluggish, but the form remains the same. It will make new highs and new lows, even though the angle is not that promising. The angle is more of sideways kind of angle, but the form remains the same. So that is the reason when Dow is talking about a new high, let's say a stock, the Dow Jones Industrial Index is like here. Now, this is the data that you have. You know that for the market to make a rally, for the market to be in a bull market like this, it needs to go above this high. So going above the previous high, remember this high is where the market was sent back lower from after hitting this high. So there is a supply here. And this supply, you will call this as a resistance. There is a resistance here. So when the market comes back above this high, it actually breaks above the resistance. It breaks above the lines of supply. The market is trying to tell you that, hey, you know what? This market or this stock is actually more worth than this particular resistance or this particular supply zone that you were selling the stock. So this is the resurgence of buyers. And this is basically a typical, simple buy signal. Do you look at any stock? Trying to find an easy situation that they're all US stocks. Give me one moment. Let's look at this. I'm going to take a simple line chart. Okay. Bad charts actually. It's not making any sense. You look at this particular correction that is going on in the market, right? Now, like I told you that an uptrend will be new highs and higher lows. Similarly, a downtrend will be lower highs and lower lows. Okay, so you can see that this is a lower high, this is a lower low, lower high, lower low, lower high, lower low, and it goes on. So the highs, the market falls, rallies a bit, is not able to come up above this high and falls again. Again there is a rally. This rally is again lower than the previous high, and then again the market falls. Again the market rallies. Again this high is lower than the previous high, and then the market falls again. So till that time, the market remains in this lower high, lower low zone, the market is going to be in a bear market. Now try to see a complete sequence of a bull market. Let's say first I'm going to draw a bull market. This is a bull market. And then ideally you keep making new highs. Okay, there are new highs here, but there will be a time when it will not go and make a new high. It will go and make a new low. It will break below this low. So this is called a lower low. So this is where a bear market has begun. Now the bear market can last whatever time it wants to last. Again, there is a rally, and again it fails to move past the previous high. In the bull market, these lows are very important, because if any low breaks, then a bear market begins. But in a bear market, the highs become more important. And then when the market starts going above the previous high, this is when it is believed that a new bull market has begun. Okay, and this chain goes on and on and on and on. So for an example, if you're looking at, let's say, Nifty, I'll go back to the chart of Nifty, and you're looking at this particular bear market that is going on. I'm going to draw a swing like this, one more swing, another swing. I can also take the smaller swing, but not important. I'm just taking the major ones. So this is how the bear market of Nifty looks like today. If we are able to cross above this particular high and move forward, we will get a Dow Theory bull market signal. This is the buy signal. Okay, so this is how it works. We'll talk more about this particular, this is called basically peak and trough progression. It is available across any asset class. It is there in every part of any data that any market trades. The markets are always going to move more or less in the same fashion. If you look at this particular stock, this is the peak, this is the fall, first rise, second fall, then a rise, then a fall, and now the market is concerned with this particular high. And if the market can go and break above this high, you will get a Dow Theory buy signal. This is what Dow wanted to achieve. This is the whole Dow Theory in a single snapshot. Okay, see, the principle of confirmation is not there right now. We are just talking about price charts. Remember that Dow wanted confirmation coming from two different indices, but the truth remains that Dow Theory can be, at a practical level, not from your exam level. The truth remains that you can virtually use Dow Theory in any stock, in any market. You want confirmation, it is good enough. Let's say, for an example, this is a Taiwanese stock, 5434. It's a scientific, Topco Scientific is the name. You find out some other company which is exactly into the same business, and then wait for a confirmation where both the stocks give a buy signal by creating higher high. That is also something that I'm just extrapolating the theory to a universal application. Any questions so far? Anybody?
So, sir, we can apply the Dow theory in Nifty also, taking two indices, bank Nifty and IT industry. If confirmation comes and both indices are going up, then Nifty is probability that it will go up. Is it true, sir?
Yeah, theoretically, yes. Just that, we are using the Bank Nifty and the IT index based on our own judgments. Dow never said anything about Bank Nifty or Nifty IT. You understand the problem or the dilemma. But see, at the very basic level, it's just a question of confirmation. You want all indices to conform to what Nifty is doing. And most of the times they will confirm. Some of the times they will not. And that is when the problems begin. That is when counter trend bear markets begin. But I think for the time being, Nifty, Bank Nifty, Nifty IT, you can also take oil and gas, and you can take mid caps and small caps. Maybe not small caps, but mid caps you can definitely take. There are also indices like Nifty Next 50 that you can take. You can take Nifty quality, you can take Nifty alpha. You can do anything. I mean, you just need a few indices to conform to each other. The best combination I like is of Nifty and Bank Nifty, because as I said, there has never been a bull market without Bank Nifty performing in it. Hoshang, yeah, you can do that.
Hello, sir.
Hi.
Can we use two confirmation for a heavy weighted stock just like Reliance or that thing or HDFC Bank?
See, you can do that, but imagine a situation where every bull market will have a queen. Every bull market will have a leader. So who are the leaders of this bull market? The leaders of this current bull market, which was going on for the last 2 to 3 years, were capital goods, were infrastructure stocks, PSU stocks, right? Oil and gas was not really a leader. So it is possible that there is a bull market in Nifty, but all these capital goods and PSUs and infra are leading the bull market, whereas oil and gas stocks are not in that much in the flavor, and they might be going up, but they're actually not leading the bull market. In that case, you can get bowled out badly because you are looking at the wrong pocket of the market. Ideally, you don't want to compare it with stocks. This goes for the question by Hoshang also. You don't want to consider because you might be looking at the wrong pocket of the market. It is much better to look at indices rather than stocks, or a group of indices also is fine. Ajita, the answer to your question is yes. Both have to give breakouts by forming higher highs. So just to if going up, no matter what the pattern, industrials have to give a higher high breakout, and at the same time, railroads also have to give a higher high breakout. This is confirmation on the upside. If industrials have broken below a previous low, then transportation should also break below the previous low, railroads or transportation. If transportation does not or industrials do not, then there is non-confirmation. Okay, so both these diagrams are of confirmation. This perfectly confirms it. You can have industrials making a new low, but transportation actually making a double bottom. This is non-confirmation. Something is not right. You have to wait for the smoke to clear. This is clear. Can I move forward?
Yes, sir.
So they have the word confirmation also appeared in the objectives of this particular chapter. So there can be some question coming about confirmation. It's not very difficult to understand. So very, very simple. A confirmed downtrend is when both averages close below their previous important lows, secondary lows. Now, you don't really need to call it secondary highs. From the exam perspective, yes, you want to remember this word secondary highs and secondary lows, but actually it applies across the board. They do not have to confirm on the exact same day, but within a reasonable period of time. Okay, which means that if industrials make a new high, Dow transports don't have to make a new high today. It can make it next week or about 15 days later also, and it will still confirm these two indices. So it is not exactly on the exact same day. They might ask you a googly question. Okay, they will say that on let's say December 11th, Dow Jones closed above the previous high, but Dow transports have not closed above the previous high. These are the following choices that you have. The confirmation is present. confirmation is inconclusive or whatever. So you need to remember this thing, that they do not have to do it on the same day. Remember, they will not ask you questions sometimes directly. They will ask you questions indirectly. You have to imagine what the examiner is trying to get at. Trends show signs of a change when one average fails to follow the other average that just made a new closing high or after it made a new closing low. See, what happens is the market is exactly a trapping mechanism. Okay. So many times, many times the markets will do something like this. And this happens even in between similar indices like Nifty and Sensex. Okay. For an example, the market has been falling. It makes this low, gives a small rally, and then let's say this was industrials, and then makes a new low. Okay, at the same time, industrials have made this low, rally just like the industrials, and then make a higher low. Okay, now you can see that this is non-confirmation. One of the things that you can do is wait for industrials to fall and follow, wait for railroads to fall and follow the industrials, but it may never happen. What may happen is that transportation might start actually rallying from here, and then industrials will also be pulled in. So basically what happened was, this was a failed breakout that we saw in industrials. We wanted to act on it, we wanted to sell, but we were not sure what transportation was doing, and then we held on and then we waited for it. So these are typical traps in the market. Maybe when amateurs are not paying attention to the market, they are missing out details of confirmation. This is what happens. And then if a failed breakout happens, the market is going to have an even superb and a strong and a solid rally, because a lot of people got trapped at the wrong point at exactly the low of a major bear market. So it creates a perfect trap. Remember this point. This is useful across the board. Like, there is breakout trading. There is also something called as fake out trading, where you look at fake breakouts and then you act on them. Shall I move forward? Let me just check if there are any questions. Hemant, good question. Since Dow used line charts, for the perspective of this exam, you will stick to line charts, meaning closing prices. But when you're doing this for practical purposes, for trading or investing, I would recommend that, yes, you use the closing prices, no doubt about it. They are the most important, but you also use the highs and lows. I have always found better success rate by incorporating the highs and lows, because the highs and lows are actually telling you the exact resistance or the support, which closing prices are not, because closing prices will always move away from the resistance or support and close somewhere a little far away. Nikhil, you may want to expand on this statement of yours. I would love to hear what you have. Hoshang is asking me, second major index remains same in every scenario or changes on the basis of market structure? I would say the latter. It changes on the basis of the market structure. It is, you have to kind of imagine certain things, okay? Because nobody has written Dow theory for Indian markets, so we have to use our own good judgment. Okay, moving on. Now we are getting into the most important aspect of the Dow theory. The problem is they have finished everything in about 3-4 statements, but it needs a little bit of explanation. Okay, so what are the 3 movements? There is a primary bull market, then there is a secondary bull market, and a minor bull market, all within the same thing. Or there can be a primary bear market, or can be a primary bear trend or a minor bear trend. Okay. Now the primary bull or bear market will last for at least a year, usually many years. A secondary bull market lasts several weeks to several months. Now, this is what Dow found about 100 years back. This needs a little bit of adjustment, and I will come to the point that I'm going to make. But remember this, that there can be questions about this. A minor bull market is a short-term price fluctuation that is going to last a few days. Okay, let's try to understand what Dow is saying here. For every single day, there will be a bar chart or a closing price or a candlestick chart that will be created. These are one day at a time I'm drawing. These one day at a time stitch together to create larger trends. So for an example, if you're building a pole or if you're creating a building, for an example, these will be bricks. Each brick for one single day. They are telling you what happened on one single day. But when you put them collectively, they create trends. Okay. Now, all trends start from minor degrees. Minor means day-to-day movements. And these day-to-day movements are connecting with each other, one day to the next day, to the third day, to the fourth day, and things like that. And because of this waving movement, they are creating trends. Okay. So minor movement is everywhere. It is today, it was there last week, it is there last month. All the trends are created by minor day-to-day movements. But these minor day-to-day movements are making visibility of the longer term trends. Okay, so Dow is talking about a primary bull market, which consists of many of these minor up and down movements, many, because the primary bull or bear market is going to last years. Let's have a look of how a primary bull market looks like. And what I'm going to show you is not perfect because there is ambiguity as far as what a primary movement means for different kind of people at different points of time. Okay, so every analyst will differ a little bit in terms of what he thinks is a primary movement or a secondary movement and things like that. But if I'm going to take the long-term chart of Nifty, remember the primary chart or the primary trend has to do with long, big movements. So which are the big movements that I can find on this chart first? So I'll start from the left-hand side. You can see there was a massive, we are looking for moves, up moves that have lasted years. Okay, so there is one move here, big move. Then from this till this, there is a big move. Then from here till all the way here, there is a massive movement. And then there is a massive downward movement. This is the 2008 crisis. Then there is again a big movement till, here or here, wherever you think it is. We don't know. There is always ambiguity with respect to that. Okay, let's stick to what we know. This looks like a primary bull market because it is large, it is lasting in years. This looks like a primary bear market. This looks like a primary bull market. And this looks like a primary bear market. And this also looks like a primary bull market. Within this primary bull and bear markets, you can see that there are smaller movements. These are called secondaries, secondary movements. Secondary movements are part of the large movement. They define the large primary bull market. And within the secondary moves, all these things that you see are minor movements. So you can see this is a secondary down. This one second, sorry, yeah. Secondary down, and secondary down has small movements. pen is giving some problems. These are the minor movements. Okay. So a long bull market separated by secondary movements. These secondary movements complete the bull market. And within the secondary bull markets, there are the small day-to-day movements, both in up and down movements, which define the entire trend. This is what Dow meant. Now, Dow is only concerned or primarily concerned with two movements. Okay, he does not pay a lot of attention to the minor bull or bear market. The Dow theory was never made to trade the minor bull or bear, though you can trade. Nobody is stopping you from doing that. But the major concern or the major thing that Dow was behind was the primary bull market and secondary bull market. Okay. The idea was that if you can find a primary bull market, let's say a primary bull market began here and it is going on. Remember, the primary bull market is going to go a long way. And now you can get in this secondary corrections, secondary bear markets, as you call them. And you can enter here in line with the long-term bull market, long-term primary trend, in the direction of the primary trend. Again, wait for a secondary, again look to buy, and again look to ride this primary bull market. Now, how do you buy these secondaries? I know this question would be there in most of you. So for an example, let's say the primary bull market has begun here. It is a first wave up, and then the secondary has begun. Now, the secondary has been making corrections, and as soon as the secondary starts making a higher high, you will get your buy signal to ride this primary bull market. So in the sense of Nifty as of today, assuming that the current correction is a secondary bear market within a large primary bull market. See, Dow theory does not do any predictions. Dow theory does not know if a primary bear market has begun at this point of time. It only knows to follow these steps. So this is how I'm going to chart the secondary bear market. And as soon as the market starts going above this previous high, you will get your buy signal through which you can ride a multi-year bull market from here. It is as simple as that. So typically a Dow theory investor, what he's trying to do is that he's trying to play this bull market. And then as soon as the bull market shows signs of lower lows, he wants to exit here and stay in cash as long as the bear market continues. And the bear market is going to bottom at some point of time. And then it is going to start creating higher highs. This is where the Dow theory buy signal is going to emerge, and then he is going to ride this bull market for a long time. And then again, at some point of time, there is going to be a bear market signal, a secondary bear market signal, through which he will exit, and then he will wait to get in again once there is a Dow theory bull market signal, and he will buy again. This is what a Dow theorist does again and again and again and again. As simple as that. You might also want to look at previous corrections, whether doing so would have actually made you any money whatsoever. Okay, so this is a 2022 correction. It depends on your point of entry. When you say higher high is also subjective at some point of time. It can get a little confusing so you have to set your eyes. It takes time. So you can say a higher high got created here, or a higher high got created here or here, as the case may be. This was a breakout, and then you can ride that bull market. There are smaller moves also, which will follow more or less the same idea. You can see a higher high here, so you get a buy signal here. Very easy to do it in hindsight, very difficult to do it in real time unless you have those skills. Sometimes you can see this higher high here also. You'll get your buy signal here. So you can buy virtually every single correction in a particular roaring bull market. All you have to do is wait for a higher high. This is the most simplistic version of the Dow theory. Theory was one of the first guys to, Charles Dow was one of the first guys to actually talk about higher highs and higher lows. And eventually and it is a powerful theory, no doubts about it, because higher highs, see, a bull market is basically a combination of higher highs plus higher lows. Okay, higher high initiates the bull market or starts the bull market. A bear market, a combination of lower high and lower low. So the lower low initiates the bear market. So even if you follow higher highs, higher lows, lower highs, lower lows, it is going to be good enough. If you are somebody who is new to this, I mean, somebody who feels that this is absolutely, I cannot see the highs and the lows and things like that, then I would strongly recommend that you do an exercise which is called swinging. So all you need to do is connect the highs and the lows. Initially, try to figure out the big highs and the big lows, big movements in the market only. Okay, and this is how the bull market progressed. As you can see, the lows were all higher and the highs were also higher. Okay, you will see. I mean, I don't even have to. This is something that is available everywhere, in every single stock that you will see. And then once you mark the bigger ones, then you go and mark the smaller ones. This will give you a great feel about how the market really moves. Okay, this is called a swinging exercise. So you can see that within this bear market, the market did not come straight down. It came down in various swings. Okay, this was a very fast swing, especially from here till here. And this is an upswing. This upswing was much slower. The more reversals that you find, up and down movement that you will find, the slower the rally will be. The fastest ones basically have no movements, no small steps, but there will be, it will still follow the higher high, higher low fundamentals. This is the best way to get a feel of the market over a period of time. And it will give you a fantastic understanding, a real intuitional understanding about how markets really move. And trading can be as simple as this, Think about it, what Dow is asking you to do. Dow is asking you to identify the primary trend, the primary bull market as the case may be. And he's telling you that, listen, go in the direction of the primary bull market, which is absolutely correct. The primary bull market will exert a lot of pressure on the market. If the primary bull market is up, it is going to exert upward pressure. If the primary bull market is down, primary market trend is down, or a bear market, then we are going to have a downward pressure on the market. All you need to do is figure out where the trend is, which way the trend is flowing, and then look at buying situations. And there are multiple ways you can use Dow theory. For an example, I can add, let's say, a moving average. I can add, let's say, a 200 period moving average. Everybody would have already heard about the 200-day moving average, yes? Yeah, I'm using the 200-week moving average right now. And then you can see that most of the bear markets coincide very near to this 200-week moving average, for an example. And then simply at these points where the market intersects or attacks the 200-day moving average, you can look for higher high signals. or any kind of buy signals, but higher tends to work in the most simplistic way, and it works well. Dow theory is very simple, but it is not something that is not of value. It is of a lot of value if you know how to use it correctly. Any questions?
Sir, I just missed. What did you compare with the Dow with the 200 moving average? What was it?
I've just plotted 200-week moving average on this particular stock, and I'm comparing the prices with the 200-day moving average, 200-week moving average. Sorry. Apparently, the 200-week, see, a moving average is the center of the chart or the center of the trend. Okay, so it is the best place where the market may want to do mean reversion. See, what happens is that when a market is in a bull market, so it will rise very fast. But this rise is based on speculation, optimism, overvaluation. Okay, so usually these markets will mean revert. All the excess that has been built in during the bull market is kind of corrected in this particular mean reversion correction. Usually, the mean reversion is very near to a long-term moving average. If it is a small mean reversion, it may come to a short-term moving average, like a 20-day or a 50-day moving average. But if it's a long-term mean reversion, it will possibly come towards the 200-day or 200-week moving average. And then from there, once it does, the market will restart its bull market again on the upside. Harsh is asking me what is a good time frame for looking at breakouts. Time frame for beginners, I always recommend them to start at least with a daily chart, because the moment you fall below the daily chart, you are in a different playing field altogether. Most fund managers, most portfolio managers will look at charts upwards of daily and weekly, at least daily and weekly. Monthly is rare. I look at monthly, but monthly is generally considered very, very rare. Usually it's daily, weekly. Look at daily, you will find great breakouts in the daily time cycle. Ajita is asking me, so the direction of minor trend and primary trend will be the same? No, not necessarily. For an example, this is a primary bull market which is going on. Now in primary bull market also, there will be some days worth of correction, and then the primary bull market is going to resume itself. So yes, this minor movement is going in the direction of the primary bull market, but this minor movement is going against the primary bull market, which is perfectly okay. The minor, even if primary bull market is up, the minor can be up, down, up, down, up, down, up, down. These are the steps of the primary bull market it is building. Suppose you want to climb a building, you are going to take steps. For an example, right? These steps are nothing but the up and down movement of the market. This is the best way to reach to the top if you want to reach, because you want to give corrections from time to time. The market cannot continue to rise every single day. That is not possible. Can you please give some insight on how to identify accumulation distribution across time frame? You cannot really. Accumulation distribution is usually, yes, there are some indicators which will give you an idea whether accumulation is happening or distribution is happening and things like that. But it is usually seen in the rear view mirror. Okay. Usually accumulation distribution is seen during sideways kind of moves, but you really don't know whether accumulation is happening or distribution is happening. Is always after the fact. Plus, accumulation distribution is not a part of this particular chapter. We are too early into this. So we'll discuss when the time is right. Hussain, ideally, you are right that mean reversion will happen sooner or later, and it is a fact of the market. Just that we don't know when the mean reversion begins. Like for an example, in Nifty today, the market is correcting. We don't really know whether this is a mean reversion or whether this is a secondary bear market, whether this is a minor bear market, minor correction, minor correction, or a secondary bear market. Secondary bear markets, if you look at secondary bear markets in India, only in India. So the primary bear market will last years, right? So if you, from that perspective, the credit crisis will definitely be a primary bear market, right? But the other ones are secondary bear markets, as you can see. I don't know about COVID. The COVID crash, you can call it a primary bear market, but it lasted only 2 months, so we don't really know. Or you can call it a secondary bear market also. So the jury is out. We don't really know. These are again secondary bear markets. Even what is happening today may look like a secondary bear market. Now, secondary bear markets correct somewhere between 15%. This one has corrected 20% approximately. This was 40%. The COVID one, 2015-16 was about 26%. 2010-11 was also about 25% Nifty. The credit crisis was minus 68% from the peak to the trough. Okay, so this is primary, no doubts about it. But these are all secondaries. Secondaries last a few weeks to a few months, say 6 months or maybe a year at the max, they will last. The definition of primary bear markets and secondary bear markets is not exactly written in stone. You have to use a little bit of imagination for that. Okay, Ajita, minor trend is everywhere. Minor trend makes secondary trends. Secondary trends make primary trends. Okay. I know this creates a lot of problem because the market is actually fractal in nature. So fractality is not easily seen. Let's assume that this is a primary bull market. This primary bull market will be made up of secondary up and down movements. Now, Dow only called these things secondaries. But the fact is that everything is a secondary. Everything is a part of primary. So secondary 1, secondary 2, secondary 3, secondary 4, secondary 5, secondary 6, secondary 7 make up this big primary bull market. But remember that Dow, when he referred to secondaries, he was only referring to the secondary corrections within a bull market. Okay, but everything technically is a secondary. These secondaries in turn are made up of minor movements. Do you understand it now? Any confusion? So minor movements are everywhere. Minor movements make the secondary movements. Secondary movements make in turn primary movements. They are the building blocks of larger trends.
Sir, how to identify the primary movement and the secondary?
There are no rules that are laid out, barring what Dow said about how much time they last. So from 2022, the market is in a rally, which looks like a primary bull market. Why? Because it has lasted multiple years. So a primary trend will last a few years, at least 1 year to 2 years, or maybe even more. The secondaries will last a few months. So you look at the current correction in Nifty today. It has already lasted for 6 months. So if the market has to bottom out now and has to start rising, then you will come back to this chart and you will say that the September 24 to February 25 correction was a secondary bear market because it lasted only a few months and now a new bull market has begun. Do you understand what I'm trying to tell you? Like for an example, today you don't know what kind of a bear market it is. And of course you don't know. It is definitely not minor because minor bear markets only last a few days. But secondary bear market lasts a few months. So this has lasted a few months. From September 2024, at least till February, maybe it will last another month. So it will be a 6-month correction. Now, let's say the market falls a little bit and then it bottoms out and starts a bull market. When you are around here, you will look at this correction as a secondary bear market. But God forbid, if the correction has to continue, the market continues to say move lower, making lower highs and lower lows, and let's say lasts beyond September of 2025, then this will become a primary correction. I'll give you one more idea to understand this. Primary bear markets usually shave off anywhere from about 40% to 60% from the peak values. Okay, 40 to 50% is normal in a primary bear market. Remember that primary bear markets don't come every single day. They come once in 10 years, once in 15 years. Say over the last 40 or 50 years in India, primary bear markets have happened, let's say about, say 3 or 4 times in this last 30 or 40 years. A secondary bear market are comparatively more common, and they are something that occurs usually every 2 to 3 years. Primary bear market will occur once in 10 years, but secondary bear market will occur every 2 to 3 years, and they will shave off anywhere between 15% to more commonly 20%, and worst is 30% from the peak. Again, markets that fall 30% are not very common. The more common is 20%. And then if you look at the minor movements, then in minor corrections, you will commonly see about 8 to 10% corrections happening every 3, 4, 6 months into the market. So if you look at the current bear market in India, we have already fallen about 16, 17%, something like that. So definitely it's not minor. It is probably secondary. So it will stop at 20% or 30% maximum. But if we are wrong about the secondary bear market, then it will go and correct 40 to 50 or 60% also. 60% is very rare, very, very rare. There's a 60% correction will occur once in, say, about 100 years or 50 years, not more than that.
Sir, one more thing I want to ask, sir.
Yeah.
Sir, you have shown that industry index and trend and the railroad trend and transportation trend. That is, you are comparing with the Nifty with the Nifty IT or Bank Nifty index. That is on a stock.
That is what?
You have shown the Nifty in industry trend line and railroads.
Right.
So I just want to ask that you have whatever you have shown, the industry means the Nifty broader index with the comparison of the railroads means the sector index, or it is a stock index, stock
It's an index, sector index.
sector index.
Yeah. Okay, Sunny just left, but Sunny was asking me, can you give me an example of a primary bear market in any index? Hope Sunny, you come back and maybe you watch the recording. You will have your answer. I'm going to show you Athens general composite. This is a perfect example that I can find of a primary bear market and the re-emergence of a primary bull market. This is absolutely a perfect example. You can see that Athens corrected from about 6,000 index level all the way to an index level of about 500 or 600. This was a 90% downward move in the Greece markets. Okay, so this is definitely a primary bear market. The primary bear market was following this particular move, and then this move. Then there was some wastage of time, and then you can see that the index has moved above the previous high, and this is where you will get your Dow theory buy signal based on pure Dow theory, nothing else. And I can show you some indices which have had massive primary bull markets also. This is Argentina Merval, a country which is having a lot of problems with respect to inflation. But look at how the index in a primary bull market has gone from almost about 200 index level. You can see this figure. What is it? It's 2,38,000. No, sorry, 23,87,385. A massive bull market. So primary bull markets do not have a measurement as such. Dow theory was never meant to predict the stock markets. They were just a study of the form of the market. Okay, they do not do any prediction. They cannot say how long the market is going to last in its bull market, how long a bear market is going to last in its bear market. All they say is the quality, or they speak about the existence of bull or bear markets. Nikhil, ideally you're right, because Charles Dow only called a wave secondary if it is moving in the opposite direction of the primary trend. So this is what Dow was talking about. If this is the primary trend, if this is your primary trend, then this move and this move is the secondary movement. And I would like you to stick to it as it is mentioned in the theory, so that there is no confusion.
All right, sir. Thank you.
You're welcome. Anisha, can you rephrase your question, because you're talking about the higher high and lower low together? It cannot be, because if the market is making a higher high, a bull market is higher high as well as higher low, not lower low. This is a higher low. Usually a bull market will continue to make higher highs and higher lows till it reaches a peak, after which it will start lower low and lower high. You can rephrase your question if I have not answered you correctly. Hoshang, you're absolutely correct. Generally speaking, you should know that you cannot really always measure how much the market will go up. Okay, so, and the markets can disassociate themselves with their previous patterns and start a massive rally altogether. See, if you look at Nvidia, this is how the market was till about 2014 or 2016 or so. Okay, so yes, it was a bull market. It is making new highs, as you can see, and it is also making higher lows. But suddenly the market picks up so swiftly that it takes the stock into a completely different zone altogether. This is because we really cannot know the extent of the rally that is possible in a particular bull market. All we can say qualitatively that a bull market exists or it doesn't exist, but we can say nothing about how far it is going to go. This is Safari Industries. Look at how the bull market progressed. And there are countless stocks like these who have done more or less the same thing in the last many years. And across the board, this is again not India, you will find these things everywhere across the world. Kaushik is asking, can we say Nifty is in a secondary bear market? Yeah, I think so. We are in a secondary bear market. But we don't know, or I don't know rather, whether this secondary bull market will transform itself into a primary bear market. That is something we don't know yet. We can only guess, because again, Dow theory does not give answers to such problems. You are absolutely correct, Ajita. This is how, yeah, you are absolutely correct. Chandan, Nifty is already forming lower lows. And in fact, in a bear market, lower lows are the first thing that will happen. If we are in a bear market, it means that lower lows are forming. You can see, right? This is the peak. Then there is a slide down. Then there is a lower high. This is a failure to go and reach the previous highs. And then eventually the market breaks this particular low. Again rallies. Again, it is lower than the previous high. And there might be another lower low again.
Okay, sir. Thank you.
Yes, correct, Anisha. Now we are talking correctly. Higher high and higher low is a function of the bull markets. Kaushik, I don't exactly know the theoretically correct answer, but if you have to compare it, you should ideally compare it with mid-cap index or the Bank Nifty or a combination of Bank Nifty and IT index, because they have the most weightages in the market today. And there is something that you will also realize or appreciate is that while Nifty and mid-cap and small caps are correcting, when you see the charts of Bank Nifty, yes, they are in secondary bear markets and all, but frankly, they have not corrected that much. This is Bank Nifty for an example. And then you have Nifty IT. You can see Nifty IT has not really corrected that much. I mean, it is down by about 10-12%, which is okay. But from a pattern perspective, it has not really done that badly. These are indications that something might be cooking in these sectors, in these defensive sectors, some defensive sectors. This is Nifty Pharma. Now, it may seem like it has corrected about 12-15%, but really the action is more sideways. Yes, it has created a lower low and things like that, but it has not really corrected that much. The ones that have corrected look something like this. This is Nifty FMCG. This is called a major correction, right? Because it's already down about 20%. So you need to see what is really happening inside the Nifty also, and it will give you a better picture. Okay, questions? Anybody else? You guys may want to read up a little bit on Dow theory. go back to your charts today or sometime during the week. And I would recommend that you start looking at long-term trends and try to identify the primary bull markets and primary bear markets. I understand that it will not always be easy initially, but it will do a lot of good to you if you start um, understanding these primary bull and bear markets, because um, ultimately, even if you're going to do short to medium term trading, for an example, you should be aware about the primary trends that are affecting the market, because they will exert a lot of pressure on the markets, whether it's a short term trend or whether it's a medium term trend. The long term trend is like the king, it's like the emperor actually. Okay, that emperor will exert a lot of pressure on all the trends. So in a typical bull market, even during a smaller correction, you may not actually want to go short in any particular stock, because uh, the strength of the primary bull market is going to exert upward pressure at some point of time. It will exert pressure when you least expect it. Okay, now market is going down, down, down. People are waiting for lower levels to buy. It may happen that those people who are on the sidelines may continue to wait for a very long time, or may actually never get the stock, because the primary bull market is still very much active. Okay, we don't have indications, or we do not have enough evidence to support that the long-term bull market itself has peaked out. That doesn't seem to be the case for the time being. Okay, so the primary bull market is going to exert its upward pressure at some point of time, and this correction is going to get short circuited, and then eventually we'll go and make a new high or a multi-month bull market from here. Yes, Ajita, it is done. No, Ashang, there are no tenets remaining. I don't think so. Yeah. So it says that Dow theory still is, the theory lives on, because nothing has changed in the market in 100 years. It will not, nothing will change in the next 100 years also. You can come up with artificial intelligence, you can come, there were neural networks, there were computers. Now the very short term minor movements might have changed, day-to-day movements, but the long-term movements still unfold exactly in the same way as they used to unfold, say about 50 years back or 100 years back. The Dow theory is never going to change. This is the best discovery that Charles Dow ever made. And now once you modernize it, and once you internalize this after doing a lot of practice, you will see Dow theory unfolding. Yes, it has certain disadvantages. It does not tell you when the bottom is going to happen, when the top is going to happen. It is not telling you how long the trend is going to rally, be in existence. In spite of that, it still remains a very, very robust theory that you can use as a base for your advanced strategies. Let your advanced strategies be in line or be in sync with the Dow theory, and you will find, maybe you will find better results. I at least found. I hope you do too.